All right, well, thank you very much to the organizers. It's great to be here. So it's gonna be fun to present a brand new paper that have not presented before, so looking forward to your feedback. All right, so let me start off by motivating tax avoidance. So tax avoidance is not that difficult to motivate. It's something that policymakers think about a lot. There's a lot of great examples like General Electric. So there's a now infamous article in the New York Times about General Electric. Back in 2010, they generated $14.2 billion in total profits, a lot of that coming from the US, but they paid zero taxes. In fact, they claimed a tax benefit of over $3 billion. And this is not just for 2010. They had many years of very low or even zero tax rates. GE was notorious for this. They had a tax department, almost 1,000 employees, and considered in itself one of the best tax law firms. And there's a fun poke at their slogan of imagination at work. They have very creative ways of avoiding taxes. Now, what I want you to focus on here and what we're going to be talking about today is that GE took a very aggressive approach in part by placing tax strategists in decision-making positions in many major manufacturing facilities and businesses around the globe. In other words, the tax department is not about just taking the production as given and then finding ways to minimize liabilities. Instead, it's really a joint decision about what projects to pursue with how to minimize liabilities. So this is happening together. They're not separate decisions. Now, GE, of course, is not alone. There's a lot of examples. Recently, big tech companies have been sort of publicly criticized for facing very low effective tax rates. It's not hard to find examples. And in fact, if you look sort of more systematically in the data, which we do in this paper, you can see this effect if you just sort on size. So this is, I'll get into the details of how we construct this, but if you look at the effective tax rates by size decile, you see this very almost monotonic decreasing pattern, okay? And it really sort of falls off once you get into the very high decile, the top decile, and the top 1% of firms. The solid line is when you look at size measured as market value, the dashed line as book value, but you get a very similar pattern. So it seems to be something systematic going on here that large firms are paying lower taxes. Okay, so finally, as a motivation, Len Burnham, who's a former Treasury official, I think puts it really nicely. We would like, sort of in an ideal system, corporations are really, their tax departments are focused on compliance, but in reality, corporations, the modern corporation views their tax department as a profit center, okay? And their decisions about what projects to take on really hinge on the tax impacts of those decisions, okay? And that, of course, has very important effects on public policy, like tax revenue, okay? Now, from a very naive perspective, you can think about tax avoidance as the firm pays less, they reduce liabilities, so the government gets less, and the firm gains by that amount. You avoid $1 in taxes, that's a transfer from the government to the firm. But of course, that's too naive of a view, because in reality, firms are making decisions about production and output and so on based on their tax liabilities and abilities to avoid taxes. And so those decisions are themselves influenced by tax liabilities, and it's not a pure transfer, okay? On top of that, not only does it affect firm policies, but it also affects equilibrium outcomes across the industry or across the aggregate economy. So this can end up distorting investment, output, competition, product prices, tax base, entry, exit. All of these things in equilibrium can be affected by the fact that firms can avoid taxes. So we want to think about all those things at the same time. Okay, so what are we doing? Well, that's exactly what we're going to do. So we want to answer the question, so in equilibrium, how does tax avoidance affect things like firm policies and value, the allocation of capital and labor, their choice of productive inputs, the concentration within the industry, productive efficiency that's resulting from allocation or misallocation of capital and labor, tax revenues collected, and the effects on how does it affect product prices and output. Okay, so that's going to be the core focus. And then we're also going to look at how policy interventions, different policy reforms, affect these outcomes in equilibrium. Okay, so what are we going to do? So we're going to develop an industry equilibrium model of firm investment. Okay, and this is most similar to Meow 2005. The twist is we're going to put tax avoidance in the model as an endogenous choice for the firm. So the firm is going to choose how much to invest or how much to engage in tax avoidance. All right, then we're going to infer the tax avoidance function, this technology to avoid taxes, using empirical tax rates, and then take the calibrated model and compare it with counterfactuals, like what would happen if we shut down tax avoidance. That will give us a measure of how different the world would look in equilibrium without tax avoidance. Okay, and one thing I want to emphasize is that we want this to be a quantitative assessment. We're going to use the model not just for qualitative features, but also to try to understand the size of these impacts. Okay. All right, so to give you a quick preview of of the results, so we find that tax avoidance in equilibrium has a significant impact on the average firm size. It increases the average firm size. If you measure it by value, it increases by about 17%. All right, that's quite a significant effect. It results in fewer firms in equilibrium and less entry. All right, there are fewer firms that are entering into the industry. We also have increased concentration. So the right tail of the distribution, those largest firms are going to get a lot bigger and produce a larger chunk of total output. So the top 1%, their value is going to increase by 20%, and their capital investment is higher by 21%. That's very different from the median firm that goes up by only a modest amount, 5% of value or 2% of capital. So this is really something that's going to affect the right tail of the distribution, these largest firms. Now, on the consumer side, this is going to lead to a lower product price and higher output. This is essentially a subsidy, a tax subsidy for production, and that's going to increase consumer surplus. In terms of the direct costs that firms are paying, are choosing to pay by engaging in tax avoidance, we estimate that to be about 1% of revenue. Okay. Now, the indirect costs, we also find in terms of misallocation that it distorts capital and labor investment, resulting in a loss of 1.5% of revenue for a total combined effect on surplus across firms, consumers, and taxpayers of 2.5%. Okay, so tax avoidance leads to sort of a welfare loss. Okay, so first, let me get into the data. Okay, so before I even start to measure tax rates and tax avoidance, I want to be clear about what I mean by tax avoidance, because this is a bit of a loaded term. There's a lot of ways of measuring this or thinking about this. For these purposes, I'm going to use a very broad definition of tax avoidance from Durang, Hanlon, and Maydew, 2008, which is tax avoidance is anything that reduces the firm's cash tax rate over a long time period. For example, 10 years, which is exactly the right word, the time horizon we're going to use. Okay, so in other words, thinking about lowering your effective tax rate and tax avoidance, those are just two sides to the same coin. Okay, for this study, we're not interested in the specific avenues that firms use to reduce their taxes. This could be there's a myriad of things that firms do. These are very interesting, and there's a whole literature that looks at these, but that's not something that we are going to be focused on in this paper. Okay. Now, why do we use long-term rates? We use long-term rates where we think they're preferable, just like Durang et al. Do, because they reduce noise. They're less noisy than annual rates. They probably have a better measure of the true tax burden for firms than an average annual rate. So firms don't care about what they're paying in a rate per year. They care about the dollars, and the dollars is sort of measured better over a longer time horizon, as the tax liabilities can shift across years. It also mitigates sample selection problems that are caused by negative income or negative tax observations that are typically dropped when you're looking at this, because they're difficult to interpret. Okay. All right, so here's how we measure the N-year cash effective tax rate. So we just take over an N-year period, we sum up all of the taxes paid and divide by the sum of the pre-tax income over that same period. Okay, now the taxes paid here, this is all taxes paid. This is a cash flow item. These are actual cash flows that firms are sending to different governments. It includes federal, state, local, foreign. It includes everything. Okay, and so this measures the total cash flow that they're paying. We're going to focus on the time period 1988 to 2017, which was a 3-decade period where there was very little change in the statutory corporate tax rates. It was either 35 or 34% at the federal level. So it gives us a nice long period of time where there wasn't a lot of changes. Okay. Now, as I said before, we're going to focus on the 10-year as the benchmark, which is the same that Durang et al. Use. Okay, so here is what we see once we've sorted firms into size deciles based on their market value of assets, and we look at the average rates within the different size bins. Okay, the first column is the same that we saw in the picture earlier. This is our benchmark rate, and we see that there's a almost an 11 percentage point decrease between the smallest and largest size deciles, and that even expands to 14 percentage points once you look into the very largest 1% of firms. Okay, and then the last two columns show just different ways of measuring this. The second column is excluding special items, which is the approach that Durang used. It's a very similar. You get a very similar pattern. In fact, it's monotonic. And the spread between small and large is very similar. You also see for a 5-year, at the 5-year horizon, again, it's not quite as large of a spread, but you get a very similar pattern. And we've looked at various different ways of measuring this, and you get a pretty robust, consistent pattern. Okay, so takeaway.
Oliver,
yes.
we have a couple of questions. I think we probably should ask them right now, because
okay.
So could you please explain how you fund cash taxes paid? For example, do you use deferred tax assets and liabilities?
So this is just the this is the cash flow item. So this is the cash taxes paid in a given year. So this is the actual flows that are going to the government or coming from the government in terms of refunds.
Okay. Do you also consider financing decisions, debt versus equity, as a part of your research agenda here, or it's only about the company production side?
So we don't. So in our model, we do not. We have. It's all. We don't have a financing decision. It's all equity financed. For what we're doing, it wouldn't matter that much because this is these are non-conforming types of tax avoidance. In other words, if you have debt, which would reduce your pre-tax, that would reduce your pre-tax income, and that would come out of this denominator. So it wouldn't cause you to lower your effective tax rate measured this way.
Okay. How does more concentration and lower product price occur at the same time? What is the intuition here?
Okay, that's a great question, and I will come back to that when we get into the model. I'll talk about that a lot.
Okay, so the tax avoidance here is fully legal, because if you follow like this definition, anything that lowers effective tax rate, that should probably include tax evasion, which is illegal.
So this is so we don't take a stance on whether it's legal or illegal. My assumption is that most of this is perfectly legal. These are numbers that are reported to in their financial statements. But there are channels that maybe you can take advantage of. For example, certain tax shelters that may or may not be legal, but you can still use them and claim them on your financial statements that affect your taxes. But we don't really take a stance on this. Our assumption is that most of this is legal.
Does requiring a longer horizon introduce upward bias in the magnitude of tax avoidance costs by skewing the sample to larger, more established firms?
So yeah, so that's a so what we do is right. So we are only including in the sample firms that have at least 10 years of data. So it is true we're getting rid of the firms that are say younger or newer. So there is a potential bias there. We haven't gone into a lot of detail or investigating that, but that's something we're looking at.
All right, thank you.
Okay, great, thank you. And that's a good segue into the next piece. So we see there's a strong negative relation between firm size and effective tax rate at the medium-long horizon. What I haven't showed you, and we don't even get into a lot of detail in the paper, is it's robust to various specifications and even including a bunch of controls if you're interested in sort of separating out the size effect from other things. We are looking at this much more closely in a work in progress that hopefully will be out in the next in a short time period, where we try to identify the sources of this. So these questions about sample selection and so on are things that we'll want to look at more closely in that project. So the big takeaway here: tax avoidance seems to be complementary to size or complementary to scale. Right? It's the larger firms that are able to achieve a lower tax rate. And that sort of is an intuitive idea that larger firms are sort of benefiting more from the ability to reduce their effective rates. Okay, so let's get into the model. Okay, so the model is a continuous time, infinite horizon industry equilibrium model. Firms are atomistic, so there's a mass of firms, and they're all each receiving idiosyncratic shocks, and they're making decisions. They're making decisions, production decisions, independent of other firms in the industry, except through the product price. So the equilibrium product price is going to be taken as given for each individual firm, and they're going to make production decisions. So the industry demand is given standard downward sloping demand function that's in equilibrium. We're going to have the price equal to this relate to quantity in this way. And firms are going to choose inputs of capital and labor to generate their output. So productivity Z is their input to the technology, the production function, and they have a decreasing returns to scale production Cobb-Douglas as presented here. Okay. Each firm has their own idiosyncratic productivity shocks, ZIT, and follows a geometric Brownian motion. Okay, and then firms are also going to exit. They'll exit endogenously, which I'll talk about in a minute, but they can also receive an exit shock, and they'll exit from the economy. Okay, so firms rent capital and they employ labor, and they also can spend on tax avoidance. All right, so this is the twist or the deviation from the standard industry equilibrium production model, is that firms also get to invest in this tax avoidance technology, which I'll call H. So a firm's going to incur cost in order to reduce their effective tax rate. And you can see that in their profit function here. They're going to choose to maximize profits, choosing capital, labor, and H. And their tax rate here is going to be a function of their choice over H. And the cost here shows up in that they have to expend cost of B times H. So B is the input cost of this tax avoidance activity. Now, what does that mean? Well, each firm's choosing their own tax rate. So the firm's effective tax rate is going to be endogenous, and it's going to vary across firms and over time. So we're going to get this heterogeneity in tax rates that firms are facing as an endogenous decision that the firm is choosing. Okay, so let's get a little bit deeper into, so what is this endogenous tax avoidance technology? So it's, first of all, it's costly, okay? And that's probably not an unreasonable assumption, right? So we can think about the different sources of these costs. So these are the most obvious are things like hiring accountants and lawyers to devise strategies to reduce tax liabilities. But I think a lot of those could also be things that are more indirect. So they come from things like earnings management, choosing when to generate earnings, production choices, how much to invest in different types of operations based on their relative tax advantages, acquisition decisions, asset sales, setting up foreign operations. All of those things affect taxes and are joint decisions with a firm's endogenous tax avoidance. Okay, so we're going to roll that all into this single function. Okay, so what does the function actually look like? How we have to specify this in the model? Well, the tax rate is going to be somewhere between, it's a piecewise function, where if you spend nothing, if h is 0, then you get the maximum rate. This is, you can think of this as the statutory rate if you don't do any tax avoidance. Now, if you invest a lot, at some point, we don't want you to be able to lower your tax rate anymore. There's some minimum tax rate that you can face. So that's going to be this rate tau L. And you achieve that if you invest some amount above this H bar. Okay, now in between is what tax rate you get for intermediate levels of spending. And I'll show you what that looks like in a minute. Okay, so as I said, the input cost is B. And again, this is going to be an endogenous tax rate that firms are choosing optimally. Okay, so what does this look like? What does this look like? Well, we have, this is the tax function as your choice of input H, how much you're willing to expend on this. And what we see is that you start, if you spend 0, you get the statutory rate. If you spend a lot, you get the lower rate. And in between, you get what looks like what is a decreasing returns technology. So initially, your initial spending on H lowers your tax rate a lot, but then to get to lower and lower rates, you have to spend more and more, which is very natural to a decreasing returns to scale technology. Okay.
So, Oliver,
Yeah.
here's a question. How should we think about heterogeneity in H? Issuing debt is different than shifting IP overseas. Does this vary with firm size?
So,
I mean, again, one way probably to think about this that perhaps at certain size, at smaller size, a certain type of technology is available, while when the firm becomes larger and probably more, more lines of business, certain other types of technology are available to her as well.
right. So that's a great question. So the way that so one way to view this, and this is sort of the way that we view this, is that the tax code that is available to every firm is the same, right? The tax code is not written specifically for different types of firms. So if you can make the decision to pursue foreign operations, you can make the decision to do all these things that lower your taxes. But the reason that you don't, and some firms do, is because they have different costs. And in fact, for a small firm, it may not create a positive return to invest in a foreign subsidiary, whereas for a large firm, it would. And that's because of that inherent cost of doing that. So there is a cost, assuming that all firms sort of face the same tax code, which they do. Okay. So firm valuation. So the value of the firm is just a discounted stream of cash flows. So they're going to choose, again, their policies over capital, labor, and tax avoidance, as well as they can exit, they can shut down if their value drops below 0. They can exit, so they can choose that as well. And so this gives us the value, just a discounted value of those cash flow streams. Okay. So entry, so another word about entry and exit. Okay, so firms enter with an initial productivity of Z naught. Okay, and they can do that. You can do that by paying some fixed cost CE. This is the cost of entry. Now, in the model, we're assuming free entry, which means that to determine the product price, it must be that the marginal firm is indifferent between entering and not entering. So the value of the entering firm, which is the left-hand side here, as a function of the price, must be equal to their cost of entry. They're exactly indifferent. So we determine the product price by adjusting price until these two quantities are equal. This cost of entry is some constant, and then the value depends on the product price. Higher product price, the value of entering is better, so we can lower that until those two things are equal. Okay. This is going to be very important because the endogenous product price is going to be, of course, the key feature here in equilibrium outcomes. Okay, so in terms of exit, as I said before, firms can endogenously choose to shut down if their productivity drops below some level ZD. They can also get hit with an exogenous exit shock and leave that way. Okay, so there's going to be this endogenous mass of entering firms, but it's going to be constant over time in a steady state equilibrium. Okay, which brings me to the next slide, which is this industry has a stationary equilibrium. So that in equilibrium, the mass of firms is not changing, the distribution of firms is not changing. However, individual firms are still getting hit with shocks, and they're still making decisions in response to that. Okay, but the exit and entry all balance out, and you get a nice stationary industry equilibrium. So this is all standard. The only twist here, again, is that we have this tax avoidance technology as an additional decision that firms are making. Okay. Okay, now, for comparison, the special case that we're going to be most interested in here is shutting down tax avoidance. Okay, so this is assuming that all firms face the same effective tax rate, and there's no heterogeneity in terms of the tax rates across firms. So this is just a special case. You can think of it as just making the tax avoidance technology infinitely costly, or the returns to scale equal to 0. And then there's just everyone faces that same statutory tax rate. So here I'm calling this tau NA, and it looks like a very the standard model. Okay, when we do this comparison for tax avoidance to see the effects of tax avoidance, we're going to leave all the other features of the model unchanged. Okay, so everything else looks the same, just a constant tax rate function. Okay. Now, our main analysis is going to compare the no avoidance case with our baseline case that matches the data. And we're going to measure the effect of tax avoidance by comparing that baseline equilibrium that matches the data with this no avoidance equilibrium. Okay, so before we get into the equilibrium, I want to walk through a couple pieces of the model to get some intuition as to what's going on. Okay, so this is the optimal tax avoidance function. This is the choice that the firm makes. We're not thinking about the equilibrium, the industry equilibrium yet. This is just what's optimal for the firm as a function of their productivity. So for firms that have very low productivity Z, they don't spend anything on tax avoidance. So their H is 0. And then as their productivity gets higher, this is a complementary input. And so they spend more and more. The value of reducing their tax rate gets higher. And then up until the point where they've minimized their tax rate, there's no more tax avoidance to pursue, and then they've capped it out here. Okay. Now that corresponds into an effective tax rate that is decreasing in Z. So we pay the full statutory rate here, and then at low Z, and then as Z increases, we pay a lower and lower effective tax rate until we've minimized that rate. Okay, and the dashed line up here just shows the no avoidance case, of course, is just flat. At all productivity levels, you face the same effective tax rate. Okay, so tax avoidance is complementary to productivity Z and to the scale of the firm. And larger firms are going to invest more in this. Okay, so how does this impact firm policies? So the real policies are investment and profits. So here on the left, we have the optimal capital decision under the baseline model where we have tax avoidance, and then the no avoidance case. So again, for very low Z, low productivity, firms look the same. They both, with or without tax avoidance, they face the same effective tax rate. And so their capital looks very similar. But then as Z gets larger, then firms are spending more on tax avoidance, lowering their effective tax rate, and so they want to invest more and produce more, and you can see that with the higher level of K, but in the blue line. Okay, and that translates into profits. Profits here are after tax. You can think of these as the cash flows to shareholders. They're very similar for low Z, but then as you get to high Z, more avoidance, lower tax rates, higher cash flows for investors. And the way I like to think about this is this tax avoidance, there is a cost. So it's not a pure subsidy, but it kind of acts like a tax subsidy. These larger firms are getting a subsidy for producing more as they face a lower tax rate. And that's going to distort their investment decisions. Okay, now that's also going to have an effect on their productive efficiency, okay? We can see that here in terms of their marginal product of capital and flip that the average cost, okay? So the marginal product of capital, we see that under the baseline and the no avoidance case are very similar for low Z, but then as productivity increases, this subsidy is causing quote unquote overinvestment. Firms are investing more because it generates more after-tax profits, even though they're producing less efficiently because they have a decreasing returns to scale production. And that subsidy is causing a lower marginal product of capital. So we get heterogeneity here, not just in tax rates, but also in their marginal products, their efficiency. And you can see that on the average cost is increasing as the firm gets more and more productive, because they're getting this tax subsidy through tax avoidance. Okay. All right. So let's parameterize the model. So all these we take pretty standard parameters either from the literature or to match the data. The new ones here are the tax rates and the parameters that govern the tax avoidance function that we specified earlier. Okay. Now we cannot directly observe these. We wouldn't even try, but we can infer them. We can estimate them from the observed tax rate outcomes, which is what I'll show you on the next slide here. Okay. So remember what we have is we have the effective tax rates by size. And we've done it here by size decile and plus the top 1%. These are the red dots that we saw before plotted as a line from the data, okay? Now, the model, the model has an implied optimal effective tax rate based on each firm choosing optimal level of tax avoidance. And over a size distribution, just like it does in the data. So what we do is we pick the tax rates and the beta and gamma, the returns to scale and the cost of tax avoidance, in order to minimize the squared error between these model moments and the data moments. Okay, so we're gonna use the data here to figure out what the parameters of tax avoidance are. Now, I think this matches, the model matches the observed tax rates quite well. So this functional choice that we made seems to actually make sense in the data. So I think this provides a nice external validation of our tax avoidance functional form. Okay. Now, of course, a standard model has a flat tax rate. That's here in this dashed line on top. Clearly, that would not match the data, this size pattern that we see in the data. Okay, so let's go to some of the baseline model outcomes. So first, just some information about tax rates. Okay, so how do tax rates look in the data? Well, we're choosing the maximum tax rate, the statutory rate, from the data, which is our about 41%. That may sound high because you're used to seeing effective tax rates, which are quite a bit lower, but actually 41% is pretty close to the average statutory rate. If you take a 35% federal rate, plus the average state rate is between 5 and 6%. So 41% is actually pretty close to what you might think is the top statutory rate. Now, in aggregate, firms are not paying that statutory rate. They're paying about 29%, significantly lower. And the average firm, the average ETR is about 35%, which is very similar to what we see in the data. Okay, and again, the difference between the aggregate and the average is coming from the fact that these largest firms are the ones who are paying the lowest effective rates. Okay, now, the second piece here, we're going to look at these, what I'll call the direct costs of tax avoidance. This is that B times H in the model. We'll add those up across all firms, how much they're spending. And again, in the model, we're putting some structure on the functional form of tax avoidance. Then we're using the data to estimate those parameters. And so the cost that we have is an estimate that's not directly observed, but is inferred from the model and the functional form. So what we find is that the model estimates of these direct tax avoidance costs are about 1% of revenue. So we would never be able to, of course, directly observe these costs, but the model allows us to infer them if we put in a little structure. Okay, so 1% of revenue, or about 6.7% of profits. Okay, which seems ballpark. It sounds maybe like a reasonable number in terms of how much firms are sort of, directly spending through accountants and lawyers, but also through opportunity costs, inefficient production decisions, and so on. Okay. So that's one of the nice things we get out of the model. Okay, so now let's look at the effects. Let's measure the effects of tax avoidance. Okay, so what am I going to do is, in order to assess the effects of tax avoidance on equilibrium outcomes, we're going to solve the equilibrium outcome in the baseline model. So this is the one that matches the data. Okay, I'll call a specific outcome XB for baseline. And then I'm going to separately solve this another model, solve the equilibrium, but I'm going to shut down tax avoidance. So everything else is the same, but now I'm assuming that GE can't spend on their tax department. They're just going to face the statutory rate. I'm going to have a different equilibrium, different distribution of firms, different outcomes, and I'm going to call that comparable quantity XNA for no avoidance. Okay, and then I'm going to call the percent increase due to tax avoidance just as the ratio of those two, the percent change between those two outcomes. So that's what I'm calling the effect of tax avoidance. All right, so let's look at those. So here is I have both aggregates and firm averages as well as industry outcomes. So first, let's look at the aggregates. So firm value, output, capital, labor, profit have all increased, or all higher because of tax avoidance. Okay, that makes sense. Firm value goes up. Firms are investing more as some of them face a lower tax rate. And also we have a lower taxes paid, significantly lower, 37% lower tax revenue. Okay, now this increased output also corresponds with a lower product price. So prices are dropping by about 3% for consumers, which together means that the revenue is declining slightly. Okay, now where is that increased production coming from? Well, if we look at the average firm, we see that the average firm size, whether measured as value or capital, labor, output, whatever, is going up by a lot. Okay, a lot more than in the aggregate. So what does that mean? That means that the mass of firms is also going down. So if you look at just the mass of firms, the number of firms in the economy, in the industry, are declining by about 7%. So even though the industry is producing more, 2.5% more, it's coming from a much larger average firm. These firms are getting bigger. And also entry is declining by 4%. So there's fewer firms coming in to produce. Now we can see that if we look into the cross section, we can see better what's happening here. So this is showing the effects of tax avoidance on the cross section. So specifically the percentiles. So if we take the percentile under the two different equilibriums and compare them, what we see is that for the median firm, the increase due to tax avoidance, firms are slightly larger, at least in terms of value and capital and output because of tax avoidance. But the larger firms at the 99th percentile, those firms are much, much bigger. In other words, tax avoidance is increasing the skewness of the firm size distribution. So it's making these large firms much, much bigger, whereas the small firms are actually not changing in size that much. And even the median firm is not getting that much bigger. This extra production is mostly coming from the larger firms, okay? And the extra value as well is coming from these larger firms. So it's not evenly distributed across the distribution, okay?
So Oliver, I think we're coming back to this question
Yeah.
of how average larger firm and can basically more concentration and lower product price occur at the same time. It's kind of hard to think about larger firms being devoid of any market power.
Okay, so so we have so this is a competitive market. So there's a homogeneous product. So there's no oligopoly power. There's no monopolistic competition. You can in this model, you can as with any decreasing returns to scale production, you can call that market power. Why do you generate rents? It could be because you have market power. So you could interpret that this way. However, the price is determined in a competitive market equilibrium. If you had, this is outside the model, but if you also had market power of, say, larger firms are able to, say, charge a higher price, then these effects would be probably even larger. But I don't want to speculate on that because that's outside of the model. But I agree that if you had market power, then some of these benefits, this tax avoidance disproportionately benefits larger firms. If those larger firms also had additional market power, they could exploit that even more, benefit even more, and you could see an even larger distortion.
All right, thank you.
So let's look at concentration, and I will come back to trying to talk through exactly why this concentration and distributional effects is happening in equilibrium. Okay, but let me first just get the sort of the summary stats of the model out of the way. So if we look at the effect of tax avoidance on concentration, so here we have we report the share of value that's coming from the top 20% of firms, the top 10%, and so on. So in other words, about 85% of total value is in the top 20% of firms. So it's a very fat right tail. Okay. Now we also report the percent increase that's due to tax avoidance, so relative to the no avoidance case. So we see that it's also increasing. So this tail, this concentration, is increasing because of tax avoidance, and you can see it getting stronger and stronger here as you get into the right tail. The top 1% is producing significantly more because of tax avoidance. And again, it's because these tax benefits disproportionately benefit those firms. Now, it's a similar pattern if you look at other measures like capital, revenue, profit. Capital is more greatly distorted, so you see an even larger increase in the concentration of like 5.5% coming from tax avoidance. Now, the one thing you don't see that in, of course, is taxes paid. Right, this is the lower tax rates are affecting the larger firms, so they're actually going to pay a smaller share of total taxes because of tax avoidance. So you see a decline in that concentration. Okay, so let's try to do a welfare analysis by looking at who's getting what. So we have firms, we have consumers that are consuming the output, and then we have tax revenue that's going to the government. Okay, so let's look at those three things separately. So the firms are better off because of tax avoidance. That's probably not surprising. Now, this table is reported differently than the previous ones. So what I'm doing here is I'm taking the dollar change, the dollar value change for the relevant party, and then I'm normalizing that. I'm expressing that as a percent of total firm revenue. And I'm doing that so these are comparable across agents. Okay, so they all have the same denominator in a sense, so I can compare across agents. So firms are 1% of their in terms of the revenue, they're 1% better off. And again, this is coming from their lower tax rates and in some sense also their higher production. Now, the price, this increased output is also has a lower product price, is going to benefit consumers. So consumer surplus is going up by about 3.3%. And then, of course, there's a reduction in the total taxes collected because of tax avoidance. So we see that's quite large, about 6.8% of firm revenue. Now, if you add those three things up, okay, you get the change in the total surplus. So the total surplus is declining by about 2.5%. Okay, so we're worse off as a society or as a total industry with tax avoidance. Now, where's that loss coming from? Well, there's two pieces. So one is there's that deadweight cost that firms are spending on that H. They're doing all this stuff that doesn't have any real productive value. It's not creating output. And so that's creating a deadweight cost. So those direct costs are about 1% of revenue. Okay. Now it turns out that that's actually smaller than that's not it's less than half of the total loss and surplus. What's left over is coming from distortions, misallocation in the productive decisions coming from this tax avoidance that's lowering productive efficiency. So firms are choosing, because of tax avoidance, they're choosing a scale that is less efficient. Average costs are going up. So even though they're producing more, they're doing it, they're having to consume more resources to do it, and productive efficiency declines. Okay, and I'm going to go on the next slide. I'll get into sort of a little bit more of why that's happening. Yeah, so the last piece is due to this misallocation, reducing productive efficiency. Okay, so let's we can see that another way. So let's look at changes in the average cost. So as I mentioned, the productive efficiency is declining. This reallocation, this misallocation that's caused by tax avoidance, this changes in the distribution and the investment choices of individual firms is causing average costs to go up. So they're being less productive, less efficient. But they're doing it in a way that, of course, benefits them. So the firms are making that decision. It's a choice. And so their after-tax profit margins are increasing. What's not increasing is their pre-tax profit margins, right? So on pre-tax basis, their investment decisions don't really make a lot of sense. It's only once you view them in the light of the fact that they can do this avoidance that they make sense. And you can also see this in terms of firm averages. If you look at the marginal products or marginal revenue products, those decline, okay? Just as we saw in the picture before. So these average costs are increasing because these large firms are in a sense reacting to the lower taxes that they face. It essentially looks like a subsidy to them. They're over-investing. They're less productive in a real sense. They're less efficient. They're making profits, but it's reducing the total productive efficiency of the industry. Okay. Now I want to try to walk through the understanding this misallocation. Okay, it's not a simple thing to explain, but let me try to go through this. Okay, so why does this tax avoidance reduce productive efficiency? Okay, so you can think of tax avoidance like a tax cut, but it's not an across the board tax cut. It's just a tax cut for large firms. Large firms are going to face a lower rate. Now remember the entry condition. The entry condition that determines the product price. So a firm who's entering, which is a small firm, a new entrant, has to be indifferent between entering and not entering. Well, those entrants are not significantly affected by tax avoidance for large firms because the chance that they become a large firm is very low. So the present value of that is really quite small. So for entrants, tax avoidance by large firms doesn't really change their value, and therefore the product price doesn't really respond very much to tax avoidance that's concentrated in larger firms. So the drop in the product price is small because of tax avoidance. And so in a sense, we can think about large firms as facing a product price that's too high given their tax rate. It's not what they would expect if it was across the board tax rate, lower tax rate that would drive the product price down. It's elevated, it's too high. So sometimes this is a competitive effect that's keeping the product price artificially high or too high. And so large firms are going to overinvest, respond to this lower tax rate by overinvesting, which lowers their efficiency with their decreasing returns to scale technology. Okay. Now, critically, this would not occur if all firms got a tax cut, right? So instead of a tax avoidance, which is lowering tax rates for the largest firms, think about across the board tax cut. Okay. In that case, you would have a very, very different outcome, which we go through in the paper, in that all firms face a lower tax rate, including entrants. That's going to significantly lower the product price. That benefit is competed away by new entrants, lowering the product price. And so large firms don't disproportionately benefit from that. Okay. And so you can think of this as sort of a competitive deterrent, that the fact that the small firms, the entrants, are not getting this lower tax rate as limiting entry and limiting competition that's competing with the larger firms. Okay, and large firms can take advantage of that. And then, so in the end, we have this. What's causing this is we have this gap in the tax rate between small and large firms that creates this inefficient allocation. It's very much about this gap or the heterogeneity across those firms.
Oliver,
Yeah.
so not to take anything away from your intuition, but rather looking back to calibration results. So you attribute all the decrease in the effective tax rate due to tax avoidance, but how much do you think of that could be driven by larger leverage of larger firms, big leverage of larger firms, and or other alternative strategies? How would that affect your results? Would you think you can see still economically meaningful effects of this avoidance?
Okay, so leverage. So leverage is a good question. So leverage would not show up in our effective tax rates because it is both reducing your taxes paid and your pre-tax income. So that is leverage would be a type of conforming tax avoidance, which would not affect the tax rate that we're measuring. So yeah, so that's sort of that's in other words, what we're capturing. You can discuss alternative measures, and there is potential possibilities that like pre-tax income firms have ways of, say, changing the pre-tax income that they're reporting that changes their effective tax rate. But things like leverage are not relevant for our measure.
Okay, thank you.
Okay, so all right, so those are the effects of tax avoidance on firm policies and equilibrium outcomes. So next, I want to do a policy experiment. Okay, so a natural policy is to, tax avoidance is could be bad for lots of reasons. Policymakers don't like it because it reduces tax revenue, even if you're not thinking about the distortionary effects of it. Let's change the policy. Let's make tax avoidance more difficult. Okay, for example, by closing, quote unquote loopholes, or increasing enforcement, whatever it may be. Let's just make it harder to do tax avoidance. And certainly, there's a lot of legislative changes that could happen that would achieve that. Now, in the model, that's equivalent to increasing the input cost of tax avoidance. This parameter B. In other words, how much do you have to, how much does it cost to engage in to lower your tax rate? So what we do, because B is not an interpretable parameter in and of itself, what we do is we choose a B such that, for this policy experiment, such that the aggregate effective tax rate goes up by 1%. All right, so we're going to make it harder to avoid and increase the aggregate ETR by 1%. This turns out in the model, this corresponds to an increase in B of about 40%. So in other words, which shows that the ETR is not very sensitive to this parameter, and it's because the large firms are the ones who are benefiting the most. There's a lot of firms that are maxing this out already, so it's not very responsive. Okay, but we're going to do this policy experiment now to show you the effect that this has. Let's look at some pictures. Okay, so I'm going to take on the left, I have this optimal spending on tax avoidance, this BH on productivity, and then on the right, I have the optimal effective tax rate that the firm chooses as a function of Z. And so what I see is that the baseline's in this solid blue line. If I increase B, I get to this green dotted line, and what that does is it reduces the amount that my spending, because the return looks not as good. I have to spend more for the same thing. So I spend less for all Z's. I spend less on tax avoidance. Okay, except the very largest firms. The very largest firms are still willing to. They're gonna keep spending more and more. Their benefits are higher, and so they're gonna spend more. But for all the smaller firms, I'm going to expend less on tax avoidance. Now, how does that translate into effective tax rates that they're choosing? Well, the green line you can see shifts out to the right? So all the firms are going to face a higher effective tax rate because the costs of avoiding are now higher until you get to the very right tail, where firms have maxed out tax avoidance and their effective tax rates are minimized. And for those largest firms, it matters in terms of the costs, but they're still going to face the same effective rates. Okay, so it's intuitively, this higher cost makes sense. Your effective tax rates go up, your spending on it goes down because it looks not as beneficial. Okay, so what happens in equilibrium? Okay, so again, we have aggregates and firm average values. So the aggregate ETR goes up by almost 1%. This is just because we didn't choose quite the right B, but basically a 1% increase in aggregate ETR. That, of course, corresponds to more taxes paid, so about 4% more in taxes paid. Aggregate firm value goes up slightly, output goes down, prices go up, and capital goes down, and so on. So this makes sense because now essentially you're making tax avoidance more costly. That means firms are investing less, their tax rates are higher, so they're investing less, lower output. Some of that's passed on to consumers in terms of higher prices. Now, what's different here, what's interesting is that if you look at the firm averages, you get a very different effect in terms of the average firm output and size. So for the average firm, ETRs go up by more because these smaller firms are more affected. Average taxes paid go up a similar amount. The value, output, revenue all go up by a positive amount. So in other words, these average firms are getting larger. And again, this is because of the fact that this is creating a wedge between small and large firms that's in the end benefiting the largest firms the most. And you can see that here in terms of concentration. So the top 1% share of revenue and other values look similar is a little over 1%. So the concentration is going up because tax avoidance is more costly. Again, if you make tax avoidance more difficult, it's not going to keep Apple from doing it, but it's going to keep sort of a medium-sized firm from doing as much of it. And you see that as well, the 99th percent of value, the largest firms in the economy are actually getting bigger. They're sort of benefiting or increasing their scale because of this.
Oliver, there are a number of government programs, both federal and state level programs, which are trying to help small firms. So you can think about this probably as these programs reducing the effective tax rate for them. What would be the implications for that in your model? Do they achieve the desirable outcomes from the policymaker perspective?
Okay, that's a really nice question. It tees up the policy experiments that we do in the paper, and I may have time to get to here. You can think about that as lowering the effective tax rate for the smaller firms, right? So kind of truncating the effective tax rate schedule. So then instead of these small firms having to engage in tax avoidance, for example, to lower their tax rate, they just get it at a lower rate because of these government programs. So what that's going to do is it's going to help compress the gap between small and large firms. And that will alleviate a lot of these problems that we're showing here. So we'll see that, we might see that later, but that's a good, it's a nice, our model suggests that those programs could be beneficial by shrinking the gap between large and small firms and actually result in things like lowering productive inefficiency.
Right.
Okay, so average firm size goes up. That's coming from an increase in the largest firms. Okay, now what is the effect on welfare? We can do the same welfare analysis. Firms in aggregate are not that much better off. So the very tiny increase in firm profits. Consumers are much worse off, or at least compared to firms, due to the higher prices and lower output. Tax revenue does go up, so the policymaker achieved that goal of increasing tax revenue, but total surplus across these three parties has declined. The reason for that is not because of these direct costs. So in fact, because the input cost went up, that means firms are going to spend less on tax avoidance. It's just not as good of a technology anymore. So they're actually spending less on that. There's less of a deadweight cost. That's a good thing. But it's going to actually further distort the allocation and reduce productive efficiency, because it's going to push even more of the production into the largest firms who are using this as essentially the tax subsidy to overproduce at a lower efficiency. So we get this decline is coming from that lower productive efficiency. For a similar intuition as before, it's exacerbating that same problem. Okay, so to summarize, so you make tax avoidance more costly. It does reduce avoidance. It does increase tax revenue, right? So that's sort of two of the maybe policy goals of doing this. However, it also has these maybe less intuitive outcomes in that it's going to actually increase the gap between large and small firms, okay? And the large firms are still going to be able to achieve very low rates, but the small firms are going to not. And so what we find is that total surplus can actually decline by making tax avoidance harder, more costly. And here we saw that consumers were sort of the losers here, and also a reduction in productive efficiency. So the takeaway here, even well-meaning like avoidance mitigation strategies and policies may actually exacerbate misallocation and reduce total welfare, which is, I think, not obvious result. Okay, so we also do other policy experiments in the model. So for example, what if we eliminated tax avoidance? So all firms face the same rate, but you can say that realistically, the no avoidance case that we've been looking at is all firms face this high statutory rate. But what if we lower the rate such that the tax revenue is neutral? Okay, so we're gonna eliminate avoidance, all firms face the same rate, but we're gonna lower that rate such that the total taxes collected stay the same. Okay, what happens there? Well, first off, we can notice the revenue neutral tax rate is significantly lower. Okay, so it's going from like 41% down to 27%. Okay, so in other words, the sticker rate that we have to charge if we don't allow any tax avoidance is much, much lower. Now, this is not as huge of a tax cut as you might think. Remember, the aggregate effective tax rate in the baseline model is about 29%. The difference here is coming from increased productivity and increased output. Okay, so let's look at what happens in aggregate. So in aggregate, firm value goes up a lot in aggregate across all firms. Output goes up quite a bit, and profits go up a lot. Now, by construction, taxes paid are approximately zero, the change in taxes paid. And interestingly, aggregate capital is also unchanged. Okay, and that's what's happening here is that firms the allocation of capital is more efficient such that you can get a 4.6% higher level of output with the same amount of capital input. Okay, and you can see already that's going to result in nice efficiency gains. Okay, so the product price is dropping a lot, so consumers are happy. They're consuming more at a lower price. And if we look at the average firm, look at the distribution, the average firm size is dropping a lot. Okay, so average firm size 15, 20, 25% smaller. So our industry is now composed of a larger number of firms, higher mass, 30% higher, but they're all on average much smaller. Okay, and that's a good thing for productive efficiency, as well as for consumers. Okay, and you can see that also if you look at the concentration, the share of the top 1% share of revenue declines, and the 99th percentile, those really large firms in the industry are getting significantly smaller. Okay, and again, if we do the welfare analysis, firms are better off, but so are consumers. In fact, consumers benefit the most. They're going to get 6% versus 1.4%. For a total surplus gain of a little over 7%. We also save on those direct costs of tax avoidance, that deadweight loss, and we estimate the productive efficiency increase of 6.5%. So production is getting a lot more efficient because we're getting rid of this gap between large and small firms, but we're also lowering the tax rate, which reduces the distortion coming from corporate taxes. All right. I think one of the other key takeaways here, firms do not capture most of this, right? So the productive efficiency gains are very large. The firm's only capturing a small fraction of that. Okay. All right. So just very briefly before I conclude, so we also do other policy experiments. So we do a tax cut in the presence of tax avoidance. So what is the implication of a tax cut with tax avoidance? Well, what it's going to do is it's going to change the whole schedule. So instead of having a flat rate, now we have a whole schedule of effective tax rates. So we have to make some decisions in the experiment of what happens to tax avoidance technology when you cut the top statutory rate. Does that lower the minimum achievable rate? Does it keep that the same and sort of just compress the rates or truncate the rates that firms face? And depending on what you decide, you get different outcomes. But across the board, what you find, which is not surprising, is that cutting the statutory rate has a much smaller effect on the aggregate ETR when you have tax avoidance, right? So if you cut the statutory rate by 5 percentage points, we find that in the model, you only get a basically 0 to 1.74 percentage point decrease in the aggregate ETR. So it's a really ineffective way of increasing the effective tax rate and taxes and potentially taxes collected. However, this is actually good policy because it narrows the gap between small and large firms by lowering that top rate that mostly benefits small firms and makes entry more enticing. That means entrants want to come in, the competitive effect, lower product prices, and that's going to increase consumer surplus, increase productive efficiency, and increase total welfare. So it still seems to have not as good of an effect as in an environment with no tax avoidance, but still it causes an increase in welfare even when you have tax avoidance, just less sensitive. We also go through a Tax Cut and Jobs Act of 2017, when the top statutory tax rate went from 35 down to 21%, which is a 14 percentage point drop. So we do that experiment inside of the model as well, but it's very similar to other tax cuts that we've done in the paper. It's just of a different magnitude. Okay, so let me conclude. So we develop an industry equilibrium model to quantify how tax avoidance affects firm policies and industry equilibriums, thinking about tax avoidance as a joint decision with other production decisions. Okay, so yes, tax avoidance, of course, leads to lower taxes paid, but it's very, very different from just cutting a tax rate. Like if you have a flat tax rate and you cut that rate, it's a very different outcome, because tax avoidance results in a very particular type of heterogeneity in tax rates across firms. It's the large firms that are the ones that end up facing the lower tax rates, whereas the small firms that are at the competitive entry point are the ones who benefit the least. And so that creates sort of a too high of a price and creates an inefficient allocation of resources. Okay, so the heterogeneity ends up distorting firm policies and equilibrium outcomes. It significantly increases average firm size, increases industry concentration, reduces entry, causes misallocation, and lowers efficiency. It's good for consumers. It lowers product prices and increases output, but does result in a total decline in surplus across firms, consumers, and taxpayers. And then finally, we also show that making tax avoidance more difficult can actually exacerbate some of the problems that we highlight in the gap between small and large firms that results in productive inefficiencies. So it can actually reduce welfare if you cut out the loopholes or you cut out the strategies that the small firms are using to reduce their tax rates. Okay, and with that, I will stop. Thank you.
All right.